Financial derivatives play a crucial role in risk management by providing tools to mitigate and manage various types of financial risks. These instruments enable market participants to hedge against price fluctuations, volatility, interest rate movements, and other uncertainties in the financial markets. Here, I will discuss in detail the role of financial derivatives in risk management. Hedging. Derivatives are widely used for hedging purposes to offset potential losses arising from adverse price movements in underlying assets. For example, futures contracts allow market participants to hedge against the risk of price changes in commodities, currencies, or financial instruments. By taking an opposite position in the derivative contract, investors can protect their portfolios from potential losses. Price discovery. Derivatives facilitate price discovery by providing a platform for participants to express their views on future asset prices. The trading of derivatives helps determine the market consensus on the future value of an underlying asset, which contributes to efficient price formation and risk management. Risk transfer. Derivatives enable the transfer of risks from one party to another. Through the use of derivatives, market participants can transfer the risk associated with an underlying asset to another party willing to assume that risk. For instance, options contracts allow investors to transfer the risk of adverse price movements to the option writer, who assumes the obligation to buy or sell the underlying asset at a predetermined price. Leverage and speculation. Derivatives offer opportunities for leverage and speculation, allowing investors to amplify their exposure to underlying assets without needing to commit the full capital required for direct investment. While this can increase potential returns, it also entails higher risks. Speculators aim to profit from anticipated price movements in derivatives contracts without holding the underlying assets. Portfolio diversification. Derivatives provide an avenue for portfolio diversification by offering exposure to different asset classes and market segments. By including derivatives in their portfolios, investors can access various markets and assets that may not be readily available or easily tradable otherwise. This diversification can help reduce overall portfolio risk by spreading it across different asset classes and geographical regions. Risk measurement and management. Financial derivatives play a crucial role in risk measurement and management for institutional investors, such as banks and insurance companies. Derivatives are used to construct complex risk models that assess the potential impact of market fluctuations and portfolio exposures. These models enable risk managers to estimate value at risk, VaR, stress testing, and scenario analysis to quantify and manage risks effectively. Arbitrage. Derivatives facilitate arbitrage opportunities by exploiting price discrepancies between related assets or markets. Market participants can profit from price differentials by simultaneously buying and selling related derivatives contracts. This arbitrage activity helps align prices across markets and ensures efficient pricing. Capital efficiency. Derivatives can enhance capital efficiency by reducing the amount of capital required for certain transactions. For example, margin requirements for futures contracts are generally lower than the full value of the underlying asset. By utilizing derivatives, investors can achieve similar exposure with a smaller capital outlay, freeing up capital for other investments. Synthetic exposure. Derivatives allow investors to create synthetic exposure to underlying assets without owning them directly. This can be particularly useful when direct ownership of the asset is impractical or costly. For instance, an investor can replicate the return profile of a stock index by using index futures or options contracts, providing a cost-effective alternative to purchasing individual stocks. In summary, financial derivatives play a vital role in risk management by providing tools for hedging, risk transfer, price discovery, portfolio diversification, risk measurement, and more. While derivatives offer opportunities to mitigate and manage risks, they also introduce their own complexities and risks, requiring careful consideration and understanding of their characteristics and potential impacts.